Disclaimer. Trading financial instruments carries risk. This material does not contain investment advice, nor should it be viewed as a personal recommendation, or an offer of, or solicitation to trade in financial instruments. Past performance is not a guide to future results.
Hello everyone and welcome to a new ATFX video. My name is Gonzalo Canete and I'm here to share with you a quick review of the week. We're going to recap absolutely all global events happened during the week and what was the effect of those events on the financial assets. I took a few notes. Let's go quickly to the screen. So let me remind you that absolutely everything happened during the week. You got all in detail by the daily report I publish on ATFX Connect blog. So you can find the report for every single day with all specific details, macroeconomical data, movement on the prices, main assets, main equity events, corporate events, macroeconomical data, and the reactions on equity, fixed income, commodities, also on currencies, and even I include also at the bottom of the report a short comment on geopolitical events. So, well, let's go to a few notes and review what was the main important events during this week. We started the week on Monday. I was just mentioned to you the last comments done by BlackRock report. They were expecting actually an inflation rising by 2025, caused mainly by the pressure on the salaries and on a labor market, which is something that has been mentioned to you in our previous reports many times. But apparently BlackRock is agree with this report and is also mentioning the possibility that maybe the inflation is not actually over and it could come back. What it is? It was here. However, in 2025, inflation will pick up again as good deflation disappears and high wage growth in the tight labor market keeps services inflation above the pre-pandemic. The view of the subject fully coincides with the view that we have been sharing with you in our reports, in our previous reports. Why is this important? Because this week, one of the most important events, it was the speech from Jerome Powell on Wednesday that actually was saying that yes, regardless what the market is expecting, and by this I mean like we have analyzing how the 2 years bond in US were reacting to the expectations of interest rate cuts. And I believe they were actually feeling disappointed by the fact that the interest rate was not happening. We got 2 drops on the yield on 2-year bonds. The main drop was caused by the negative report on labor market of November 2023. It doesn't matter if by December that labor market report was actually improving back again the conditions on the labor market in US. It doesn't matter because by then in December, Jerome Powell was actually promising, putting on the table the option to cut interest rate, which is something Wall Street was expecting, and therefore it caused a massive wave of euphoria on the market since then. Because since then, since that December 2023, we have seen how the market almost every week is breaking up new maximum, new tops on all equity index, not even in US only, but also in Europe. Because we have seen also DAX 40 breaking up new maximums. Now, the thing is, this is the main asset I was telling you to follow up to understand what is the feeling of the market in terms of or in relation with the interest rate cuts. Why? Because as you can see, it was dropping and dropping again until, well, with the negative labor market, because they know that the relation between inflation and unemployment rate are reversal. So if unemployment rate is rising, it means the inflation gonna drop. Something that actually didn't happen. Based on that expectation that in economy is called Phillips curve, the reversal relation between unemployment rate and inflation, it was given to the market the main clue about what's going to happen with the inflation. It didn't happen because even when unemployment rate was rising by 3.9%, which it was the case here and a case over here again, the last report, it was given us an increase in unemployment rate to 3.9%, but it's still low, below 4%. So this is the causes that it was pushing down the yield on 2 years bond, but also during the first months of 2024, while the market released that the interest rate cut, it was not going to happen in March. Remember, since December, they were discounting that probably in March will be the first interest rate cut decision. It didn't happen. And because it didn't happen by the end of February, the yield was actually rising back again. because they released that actually interest rate it was not happening, and therefore the expectations were coming back again to increase the yields. What happens next? We have seen that the spike on the inflation rate, the last one, which it was rising back again just a little bit, it was causing again the yield and also the dollar index rising. But the last words from Jerome Powell was actually giving us a drop on the yield of 2 years bonds, which is again naturally reflecting the expectation for interest rate cuts are coming back to the main area, but still are not losing the 200 moving average, and still they are not dropping below 4.50% of yield return, which is for me is the barrier that we are expecting. So in summary, if we see that the bond is not dropping through below these levels, it means that the interest rate cut is not buying by the investors. They are not really trusting completely to Federal Reserve to cut interest rates. However, they insist, remember, in the speech, Jerome Powell was insisting this week that interest rate cut is going to happen, and they are so serious about this. Now, the reaction of the market overall, it was also dropping on the dollar. As I was saying to you, during the speech done on Friday evening, we seen how the dollar was dropping back again, but the last two sessions, including Thursday and Friday, was rising strongly again. So this is the reaction of the dollar index, which is causing, first of all, bearish reaction on euro dollar, obviously. And if you take a look on long term to this chart, everything makes a lot of sense, because technically speaking, the chart is inviting the price to, it's more than 15 years historical chart, is inviting to you to drop the price back again, not even to a parity, but even below the parity between euro dollar to a new record low, which will be 0.95, 0.92 even. Now, saying that was a natural reaction, it's also this reaction, this chart, this drop on euro dollar, it's also supported by fundamentals, by a macroeconomical view, because if you consider that the growth rate in Europe is too low and it's so weak, I mean, we are talking about PMIs this week published. Germany was dropping to 41.6%, the PMI on manufacturing, which is one of the lowest never registered. It's right here. However, for Europe, the French and German PMI are still below 50%, which indicate contraction in the economy. Of particular concern is the German manufacturing PMI, which has fallen to 41.6%, record low in many years. And still the PMIs from US are strong and keep showing expansion on the economy. Therefore, the natural relation between euro dollar, what is this? Sell euro assets and buy dollar assets, which means like a kind of reflow of the money, of the risk and the capital from euro to dollar assets. That's natural flow, and therefore it's a bearish correlation on euro dollar pair, and that's what we could expect. In terms of commodity, we have seen how the adjustment of gold was reacting, actually rising so strongly when the dollar was dropping, and based on the words from Federal Reserve, even to a new record, which it was $2,222 per ounce. You can see the candle here, but clearly is not going so far anymore. But still is holding really good positions in $2,160. It's right now, it's here, but you can see that the candle was actually retracement massively from that to top new records. This is based on the probably the factor of the dollar is if the interest rate cut happens, dollar gonna get weaker, and therefore the euro is not an option because European Union got many issues. The German economy is not growing, and therefore if I'm an investor, probably I prefer either dollar or either gold. So if the dollar is not going well, I go to gold. If the Federal Reserve is telling me they're gonna cut interest rates on dollar, therefore I take gold as an option to preserve the value of my assets. So that makes a lot of sense. We also have seen how oil was rising. It touched the levels that we got for many weeks here as a main areas of resistance and target, and immediately after was dropping back again. One of the reasons that it was feeding this bullish movement in the oil, it was mentioned in our report on Monday, which it was probably Option A, it was caused by the attacks from Ukrainian missiles and drones on refinery installations, oil refinery installations, Russian oil refinery installations during the week. So that probably affect, they say, by 600 millions of barrels daily, I believe. 600,000 barrels per day to the production, to the offer. So that could cause this spike on the price. Still, they say also refineries in India are dropping in production, but they also say that are rising on production, but importation are dropping in India. We mentioned this factor before with certain numbers. Even I shared with you the charts in previous reports. We also got from China, apparently based on the numbers given by China, the last 2 months this year, they increased the demand of oil above the expectations, which is a really good sign, because in technically speaking, in theory, if these numbers are real, it means that China is consuming more oil because they are increasing the activity, industrial activity, and therefore that main risk we have faced on 2023, which is a slowdown of the second biggest economy in the world, which is China, should be gone, and they are actually consuming oil because the things are going well. Now, what else? 2 important events happened this week, apart of the Jerome Powell speech that we already mentioned, and we already have analyzed more or less what was the fact and the words that he said. We got the Bank of Japan and we got the Bank of Finland. Bank of Japan was happened on Tuesday. They decided to increase interest rate. However, the reaction of the market was completely the opposite of that decision. It means, even when they announced that they increased the interest rates, which is from negative to 0, actually, so technically speaking, they are not even putting a positive interest rate yet. The reaction of the yen, instead of getting stronger against the dollar, it was getting weaker. And even the bond was dropping instead of rising, which it was what you will expect in the yields of the bond and the currency if they announce an increase on the interest rates. Why didn't happen? Why actually happens the opposite of what we could expect? One of the reasons, I believe, is the comments that Weather was including, attaching to this announcement, which it was, they say, they increase interest rates, but still they will continue buying in the same amount government bonds in the market, which means they're gonna keep printing yens regardless the increase of the interest rates. So in my opinion, that kind of comment neutralizes completely the intention that you are announcing of increase the interest rates. So I believe that's the main reason. You can even see that the dollar yen is not actually reacting in that way at all. After they announced the interest rate cuts, the yen was getting weaker against the dollar, and the dollar was actually pulling up again the yen. We are getting close to 160. This is the top maximum record on the last 30 years. This is coming from April 1990. We need to keep eyes on this, because I believe if by any chance Japan is going to those levels, dollar yen is going to those levels, a massive sellout could happen in that levels. Keep in mind that this week on Friday, the night from Thursday to Friday, Japan published the inflation rate, which it was dropping until now, which is the last one, it was 2%, and now they got a spike again on inflation that moved the inflation rate in Japan to 2.8%. On the top of that, I mentioned on the reports on Monday that Toyota was announcing on Monday that they are increasing 25% the salaries to all the employments in the industry. And they believe that therefore the rest of the industries, the rest of the sector, companies in the industry, they're probably going to increase the interest rate, which is the highest increase on salaries since the last 30 years, I believe. That was the comments I quote based on Reuters report. It means that actually, if the inflation is back to 2.8% and they are actually rising the salaries, there is no way they're going to contain the inflation in the future. And therefore, Bank of Japan needs to keep pushing forward the interest rates to new levels and somehow decrease the liquidity. And that's the problem. They cannot fight inflation by keep buying the same amount of bonds. They need to reduce the liquidity and reduce the monetary offer in order to contain the prices. And so if in one hand they announce an increase on the interest rate, but in the other hand they announce that they are keep printing money and injecting money in the economy through taking the bonds and putting the yens into the market, that's not gonna work. And therefore we know that we need to wait for new, better ideas from Bank of Japan in the coming weeks. And I'm sure that we're gonna hear about that soon. Bank of England is the last one. Central Bank, Bank of England. Bailey, the governor of Bank of England, was actually suggesting that the things are getting ready to cut interest rates, and therefore the pound obviously was adjusting, dropping against the dollar, as you can see here. Would make a lot of sense because we have been mentioned this also this trade. The correlation with euro dollar is also interesting in this case, but it's dropping because the pound is getting weaker based on the announcements of Bank of England. They got the intention to cut interest rate. There is two factors, macroeconomical factors here, that made us to believe that the things are not that clear like they mentioned here, and therefore we can see certain changes on this pair and also on FTSE and London Stock Exchange. Why? Because from one perspective, UK economy is close, more similar to US economy, but from another perspective is similar to German economy. From an unemployment rate, which is one of the main factors that is affecting the decisions of the central bankers right now, because if the unemployment rate is too low, which is the case of US and is the case of England, the unemployment rate in England is below 4%, it's 3.9%, 3.7% right now. It means that the salaries keep pushing forward, especially in the service sector, and therefore the inflation is gonna probably remain sticky there. But the growth rate is dropping, and if the growth rate is dropping, and we have seen how United Kingdom saw as a growth rate that is super low, very similar to the German one. This is the growth rate. So with this growth rate, you probably need to activate the stimulus and reduce the financial cost of the interest rates. So therefore they probably need to cut interest rates. But considering the unemployment rate right now in the United Kingdom, which is 3.9%, they still could have a problem with inflation. And actually the inflation in the United Kingdom is getting flat. Regardless what they say, regardless of the governor of Bank of England saying the things are getting there, the things are not getting there. This is the inflation, and I see more or less flat inflation. And remember, the comments published by BlackRock, and I share with you that comments on report on Monday, past Monday, that comments from BlackRock say that they clearly bet on an increase on inflation for the next year. So keep that on your radar, okay? I think this is all. I try to do my best just summarizing all. I hope you enjoyed this report. And remember, if you really do so, please subscribe to the channel, give me a thumb up. And also, if you want to contact to, I don't know, suggest any kind of asset to analyze, or you want to participate in any of the podcasts and reports we are doing, please contact me. I'm trying to find here my contact details. It's here. You got my email right there, so you can contact me through the email, and I'm really happy to participate with you, even to if you want to organize a podcast here too, or if you want to request any particular monographic or study on certain assets, let me know, bring me the ideas, leave the comments on the bottom of this video, and I'm gonna work on that. Okay, take care, have a good weekend, and see you in the next financial market report. Okay, bye bye.